Is there an exception to related party installment sales? Installment sale, like a special payment plan. Instead of getting all the money from selling a property at once, you get it bit by bit over time. This helps with taxes and make payments more manageable. But if you are selling to a family or a business that you are involved in, things get a bit more complicated. Let's break it down with an example. Imagine you sell a property for $900,000, but it originally cost you $600K. Under this payment plan called installment sales, you have to pay taxes on the profit you make, but not all at once. Instead, you pay taxes on a little bit of profit every year. So, here's how we figure it out. First, we'll find the profits you make by subtracting what you pay for the property from what you sold it for. In this case, it's $900K minus $600K, that's $300K. Then, we figure out what percentage of the sale price that profit represents. That's just by dividing the profit by the sale price. So 300K divided by 900K, you get 33.3%. Now, let's say you agree to receive 120K each year from the buyer. To find out how much of that is taxable, we multiply it by the percentage we just found. So 120K minus 33.3%, that's $39,960. So each year, you will owe taxes on $39,960 on your 120K payment. This way, instead of getting hit with a big tax bill all at once, you spread it out over time. Alright, now we have covered the basics of installment sales. Let's dive deeper into a specific scenario. Selling property to a related person. This adds another layer of complexity to the process. So we will unpack it step by step. When you sell depreciable property to someone related to you, such as a family member or a closely held business, the IRS tax notice is concerned that the transaction might be used to manipulate tax obligations. As a result, you might not be able to use the installment method to report the sale. Instead, all the payments are considered received at the year of the sales, potentially impacting your tax situation significantly. However, there's a glimmer of hope amidst this complexity. An exception exists if you can demonstrate to the IRS that the sales wasn't primarily aimed for dodging taxes, especially if there's no significant tax deferral benefit from the sale. You might still be able to use the installment method. It's not all about showing the IRS that the tax avoidance wasn't your prime motive and that the transaction served as a genuine economic purpose. But who exactly counts as related person? According to the IRS, well, it's broader than you may think. In addition to immediate family member, it includes a range of relationships. For example, it could encompass entities controlled by the same person. Trust whether you or your spouse were beneficiaries, or even partnership where you own more than half of the interest. It's crucial to understand these relationships to navigate the tax implication accurately. If the related person you sold a property to turn around and sell or disposes of it themselves, additional special rules come into play. If the second disposition happens before they are finished paying you for the property or within 2 years of the initial sales, things might get a bit messy. Under these circumstances, part or all of the related person gains from that second sale could be treated as if you receive it at the time of their sale. It's a way to prevent potential tax shenanigans down the road and ensure the IRS doesn't miss out on the share of the tax owed. They're smart, right? In navigating this complexity, seeking expert advice is important, so you consult with a tax professional or legal expert for your specific situation. So, in summary, selling property to a related person under installment arrangement involves special tax consideration. To understand the rules is important. Phew, that was quite a journey, right, through this whole thing. So remember, when in doubt, do consult your preferred tax pro. I'll see you at the next video.